Hey, what's up, guys? Doing another video today, and I'm going to get into behavioral finance. So, I'm going to be filming probably 3 or 4 videos in a row. So, guys, please bear with me. So, for behavioral finance, I'm going to get into two key things that people do when investing. You have emotional behavioral finance, and also may lead to herd behavior. So, I'm going to try and do each video now from now on in maybe 6, 7 minutes or less. I just want to get the point out. I don't want to ramble. So, guys, bear with me, please. Let's go ahead and go. Emotional gap behavior with behavioral finance. So I have my definitions up here. It says the emotional gap refers to decision based making on extreme emotions or emotional strands such as anxiety, anger, fear, or excitement. And then at a keynote at the end, oftentimes emotions are a key reason why people do not make rational choices. So with that also has a definition of herd behavior, where herd behavior says it states that people tend to mimic the financial behaviors of the majority of the herd. Herding is notorious in the stock market due to dramatic rallies and sell-offs. So I know there's also FOMO, which is fear of missing out as well, which is when somebody says, oh, if I don't have this stock right now, and I believe I talked about it before, if I don't have the stock right now, let me go buy it so that way I can get into the mix. But that may be the key reason why you are losing money. So when you tie all this in together, the emotional aspect of behavioral finance is that when you're investing, you need to not look at what everybody else is doing, but look at what you're doing. Do your due diligence, do your DD, do your research on these items. You cannot go into an investment period and say, well, for example, and I always love using the GameStop fiasco as one giant example for everybody to understand. Number one, let's say the GameStop thing is happening right now again, and let's say it shoots up to about $150 per share. People will say, oh, if all the retail investors are going ahead and buying that, let me go ahead and get in soon. So let's just say you set a market buy at when the market opens at 300. Let's just say it just doubled dramatically overnight, and you have to buy it at 300, and you say, well, okay, I'll have me a stock and I hope it goes up now. Or let's say you see it's a couple weeks in, it goes to 400, and you say, oh wow, I got to get in. From what I remember, I saw it one time in the morning when I was working. I was at 440 per share, I believe, and I saw people on Twitter saying, oh, I'm gonna buy in, it's gonna go to 1,000, it's gonna go to 1,000. Little did they know that was the beginning of the end. See, that's because it's emotional behavioral finance. You are tied. You have a lot of anxiety and excitement right there. So that anxiety and excitement drives you to say, well, I need to go ahead and buy that, when you know that is not the rational decision. Because number one, that is something that's very unheard of, unprecedented. That's something that has not been recorded in history of happening. So whenever it comes time for you to see multiple penny stocks rise, or multiple stocks that you feel like don't have the fundamental value, that is overvalued per se, you may say, okay, let me go ahead and jump on the train. People on Reddit are talking about it. People on Twitter are talking about it. You cannot listen to people that are pushing and pumping a stock, which comes to herd behavior. When everybody gets together and say, let's pump up a stock or let's sell off a stock to make it go down. Yes, investors can do that, but at the same time, be smart about your money. If you get in right at the start when everybody's doing it, I guess good for you. But at the same time, if you get in while it's going on, you need to know your position. You can't sit there and say, oh, I'm going to hold this loss forever, when you know that in reality point, that stock may never ever reach the highs that you bought it at again, simply for the fact because that herd behavior moved it so high or moved it down so low that you bought in too high or you bought in too late. So you bought in too high on the later end of when that stock went up and then it crashed back down, or you bought in at the beginning too low and then you expect it to keep dropping lower. So you're going to be holding a specific share or a specific amount of shares because of your emotions. So the main thing is check yourself emotionally before you start investing. Don't use fear of missing out and saying, well, if people got into X amount of stock and they had a high turnaround from it, then I need to do the same, because you're playing with your money. Maybe they have tens of thousands, maybe hundreds of thousands that they're putting at risk on that, and they have their reward because they got it at the time that they got in. But you can make a lot of great money in the market if you just invest intelligently. You can do ETFs, do things that pay you dividends, do things that give you good growth. Maybe you want to do some blue chip stocks. But the thing is, invest in items that will help keep your money stable. Invest in things that are more stable than others. You can take the stock market is a big risk. You can take the risk as much as you want, but understand, take calculated risks. Don't just go in because you see other people doing it. Monkey see, monkey do does not help you in the stock market. You can have advice from financial professionals and they can tell you, hey, we recommend this. They will most likely going to give you almost the same runaround of, hey, this is safe, this is safe. This can get you a little more risk, but it's safer than doing a stock that you want pure capital appreciation on, and you know that it's very extreme high risk. That's just like buying a junk bond and saying, well, I know it's high risk, but it can give me high reward. So whenever you're in the market, check your emotions. Don't follow the herd unless I guess you're starting with the herd. But remember, check your emotions, because if you have extreme anxiety and excitement at the same time, you're going to click buy on a stock. Just like when people did for GameStop, they bought in at the high and said it's going to go to 1,000. And turns out it went back down all the way below $10. And then people were looking foolish because they bought with emotions. They didn't buy with intelligence. They bought with emotions. And then they missed out on when the wave started. So therefore, they were already at a disadvantage. When you're looking into stocks, please check your emotions. Do not go ahead and click buy, buy, buy. And the same goes for sell. If you have something and you feel like, oh, I can hold it longer to get a better profit, I've done my due diligence, you do that. But don't start a massive sell-off because you see, oh, the market's crashing, the market's taking out to sell, 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 sell. Remember your capital gains, short term, long term. Remember the tax percentages on that, short term and long term. So whenever you're buying or selling in the market, do it intelligently, do it rationally. Don't do it off of emotion. So guys, I just want to touch point with that. I think that's very crucial. People have to understand that point. Stop letting other people drive you. It's your own money. Don't let somebody else drive your money unless they're a true professional. Thank you guys for watching. Tune in next time for the next video.